Hi everyone, this is Handyman for the Everyman. If you follow my channel, which many of you may not, I normally just do like random handyman stuff around the house. But this video is different. I'm going to be talking about the actual house that you live in and the house prices, because this is a very important topic and I think everybody should have an understanding of what's going on. And I'm going to be presenting to you an idea that is really not talked about very much in the mainstream media. And I've picked it up from a few YouTubers and from reading different articles. And I just want to get this message out there because it's extremely important to understand and it really is missing. So I present to you why house prices will keep rising in Australia and the one reason that no one seems to want to talk about. So as you know, it's coming to an election for those of you that are in Australia. And this was a story that came out, I think it was late last year, where everybody found out that Anthony Albanese bought a $4.3 million house and there was a little bit of an uproar. And then everybody realized, oh, actually houses in Sydney are kind of like all pretty expensive. So this has become such a politicized point, and so people are banging on about all the ways that the government can help to reduce house prices, but then we don't really want to reduce house prices because we don't want everyone to lose value in their home, so we just don't want them to rise too much. And so we're talking about housing affordability, but nobody actually wants the house prices to drop. I went to artificial intelligence on multiple platforms. Perplexity, I even asked DeepSeek, and then I asked ChatGPT. And the question that I asked AI was, why did Australian house prices rise so much in the last 20 years? This is the answer that it gave me. Number one, population growth. Number two, undersupply of new homes. Number three, the low construction pipeline. Four, potential interest rate cuts. Five, rising construction costs. Six, demographics, economic growth, the wealth effect, limited land availability, and historical resilience. So these were the 10 reasons why the house prices have been going up in the last 20 years according to AI. Now, the one reason that I want to talk about today was not even not directly listed in this list. Now, there's a really good article by Lindemann Reports that argue why the house prices will keep rising. And in the report, it actually outlined a few very important factors, which covered some of these factors here. One of them was home loan rates, because home loan rates have actually dropped since the 90s when my parents had their house. There was one point in Australia where we had 18% sort of interest rate. So even if you only had a $100,000 loan, you're paying 18% of that $100,000 loan. So the servicing was actually very high. And then, as you know, during the COVID era, the interest rates dropped to ridiculously low rates. So you could buy a house with a 3% interest rate or 4% interest rate, and so you could service a much bigger loan. So because the price of a house, you're not actually paying cash for it. Most people, when they buy the house, they're not paying cash. So you only need to save the deposit. So one of the reasons why the house prices keep going up is because if the interest rates drop, then you can actually service a much bigger loan, okay? But that's all good and stuff that you can borrow that much money. But the problem is that wages have been going up in this sort of linear fashion, but look at the way that the residential property prices have been going. Now, what it means is that if you're earning the median amount here, and then you're earning the median amount here, look at the gap between the property price and your wage. In real terms, it means that the residential property prices have gone up ridiculously. So the average worker, everybody knows this, everybody's talking about in Australia, the average person coming out of uni now is going to really struggle to save up the deposit for their house, especially if you're in the bigger cities like Sydney and Melbourne. So we all know that house prices have grown much faster than incomes. And you can see this graph here. This is taken data from the ABS, and this is from the report that I referenced before. And you've got dwelling prices, and they've been going up. average full-time earnings have been pretty flat, as you can see there. And this is a sort of linear rise in average full-time earnings, and you've got almost like a logarithmic rising prices for house prices. And the question is, why are the house prices going so high? Now, you might argue, well, house prices don't always go up, and sometimes they go down. And certainly we've seen over the years that you can have big events like World War I, Great Depression, credit squeeze, the recession, GFC. But despite all these major corrections, house prices look like this. Look like this. They just keep going up and up and up. We also know that house prices move with inflation. So as inflation goes up, house prices tend to go up. Now, one of the things that I used to think, and this was probably until about 5 to 6 years ago, I thought there's no way that house prices will keep going up because people won't be able to afford a house. So, you know, at some point they just get so expensive. Like in Sydney, they're like $1.4 million now. If you're coming out of uni and you're earning even if you're earning $100,000, you're going to struggle to save the deposit, let alone pay service that $1.4 million house. So in my naive mind, I thought, well, there's a cap to this. It's just we're going to reach a point where the median house price is beyond what the first home buyer can buy, and then so nobody's going to buy those houses, so the house prices will just keep low. But the reality is, now listen guys, the reality is most of the houses in Australia are either owned by investors or by owners who have fully paid off their house. Look at this graph. You've got fully owned, this is the percentage of fully owned properties, then owned with a mortgage, and then investor owned. And you can see that the majority are owned by either people that own their house outright or are investors. So think about it. There is no political will to reduce the house prices, to make housing more affordable, because these people that own the houses want the prices to go up. These people that own houses because they invest in the houses want the prices to go up. So everybody's crying, oh, the house prices are too high. But nobody actually, well, very few people actually want the house prices to go down. So there's actually a lot of problems if the house prices go down, including negative equity. People are going to have to sell their house and be essentially broke because they owe more money than they own, etc. So that's one of the reasons why house prices in Australia are very unlikely to go backwards, because there's no political will, simply because most people that have houses actually own them outright or they're investors. Now, so this actually blows the argument that I used to have, which was, okay, well, you know, people are going to just not be able to afford their house. Well, of course they can afford their house, because what they'll do is, as their other house is going up, they just sell that house and then buy the other expensive house because they already own that house. So the actual number of people that own a house with a mortgage are actually a smaller percentage, okay? So that is one thing that really broke my brain. This is just another graph to show Perth that this problem is all across Australia, and Perth has been doing has had ridiculously high growth in the last few years. And you can see here Sydney's capping out at $1.2 million for median dwellings. But there's one thing that nobody's talking about, including AI, that refuse to talk about this point. And I'm going to bring up this next slide to talk about one of the biggest issues that nobody's talking about. We talked about immigration, people arguing about, oh, there's too many people coming in. Yeah, that might be true to an extent. There's not enough supply. We need to build more houses. Yes, that's true to an extent. And there are a lot of other structural issues that we have, the zoning laws, etc. And they're all, I'm not saying they don't contribute, but here's one issue that really nobody in the media, not in any big newspapers, are really talking about. And that is that Australia's money supply has gone ballistic, and it has increased by a very large portion. So this is from the btclub.com.au, and this is an article about the money supply. And it says here that from 1990 to 2016, Australia printed $700 billion, which meant that you went up 1,644% increase over 26 years, which is an average of 7.17% annually. Okay? So what that means that essentially that we've actually printed so much money that the value of money is actually 7.17% less every year. And you're thinking, well, hold on, no, handyman, no, that's not true because the CPI only goes up by 2 to 3%. Yeah, the CPI only goes up 2 to 3%, but the CPI doesn't count asset prices. And this is the big point, is that asset prices are going up on average around that 7% mark. Do you see what I'm saying now? Because asset prices are essentially just going up at about 7%, which is roughly the same amount as the money supply has been going up. Now, I'm not saying that they're one-to-one correlated, but they're very close. From 2016 to 2024, the M1 supply, which is not the M3 supply, but the M1 supply, doubled to 1.67 trillion. It doubled. So it took 40 years to reach 700 billion and then 5 years to double it, increasing by 2.3 times. This captures the COVID era where there was quantitative easing done by the RBA for the first time in history, where there was just a lot of money printed. So I don't pretend to understand the complexities or the blah, blah, blah about all this. But what I do understand is simple economics. If you print money, you make money out of nothing, and then you just pump it into the economy, eventually there are repercussions. And the repercussions are that prices go up, inflation, but not just inflation. Where does the money ultimately go to? It goes into assets. So you see the stock market has gone ballistic. You see the house prices have gone ballistic. So think about it. It's doubled the money supply. In other words, the amount of money that's in the system has doubled in the last, 8 years. Most of it done since COVID. Doubled. So is it any surprise that house prices have gone up? Look at this. What I've done here is I've just put the graph on top of the other graph. So here we've got M3, which is the total money supply, this grey graph, which has been going up steadily from 1984 to 2002. And then you can see from 2004 onwards, the money supply in Australia, in other words, the amount of money that the RBA that has let into the economy has gone up from, so essentially, like I said, from 2016 here to 2024, it's actually doubled in this period of time. Okay? And you can see the graph here, 1,500 around here and 3,000 here, it's roughly double. And what I've done is I've put the other graph that we saw before, which is residential property prices from the same year, 2004. This is wages growth, by the way, that blue line. And then you've got this crazy residential property prices, which have steadily gone up. Now, doesn't that look similar? Okay? I'm not saying that it's definitely not the only cause, but it's definitely a big cause. So the question is, are the house prices actually going up? And if you look at this graph, which I took from a website, you'll have to look it up yourself, easylearn.com.au there's an article here about buying gold. Anyway, that's not really the point. I'm not telling you to buy gold, but I'm just using gold as an example of a store of value that is not currency, that is not fiat currency. So gold, there's a limited amount of gold, and so so you could argue that gold tells you what the real value of the money is, okay, and of an asset is. And so here we've got, if you track gold, this is the gold graph, and it's been going up in price, and you track Perth house prices or Sydney house prices, you can see that they track very similarly. So you've got gold going up in price, you've got house prices going in price. And essentially what that tells me is that the value of the house prices are going up in a similar way that gold is going up. What does that actually mean? It means that the price of money is actually dropping. Sorry, the value of money is actually dropping. So both of these assets are just holding value, and whilst money itself is losing value. So what does that mean? So to try to explain it, what that means is that your $1,000 in 1950 is not $1,000 obviously now. That $1,000 has been debased, has been devalued because you keep printing money into the system until it's worth way less. Okay, so between 2016 and 2024, your $1 is now worth about 50 cents. So, and if your house price went up 100% in that time, which you roughly did in Perth, it went up like 83%, I think, over the last 5 years. It basically doubled. House prices have essentially doubled in the last 8 years. But what's actually happened is that money itself is worth about half. And you can see that when you go to McDonald's. But the McDonald's pricing is actually hasn't gone up as much as house prices have gone up. So I asked Perplexity again, how does increasing money supply increase house prices? And this is the mechanism. Number one, it lowers interest rates because money is cheaper. It increases borrowing capacity. It inflates asset prices. So this is not a very good answer because it's actually just saying I asked how does it increase it? It says, well, it inflates asset prices. Well, what it does is it often leads to asset price inflation, including real estate. Investors may view property as a hedge against inflation, further driving demand and price upwards. The wealth effect. So when you put more money into the system, people feel richer, and so they tend to spend more, but they also want to buy more expensive houses. You get more investor demand because there's more liquidity. And whilst you do all that and you're increasing demand because you've got more money and more people want to buy more houses and more expensive houses, that doesn't mean that you can make more houses easily, okay? And then AI is very cheeky and it says, oh, well, it's very complex and blah, blah, blah. And so it doesn't necessarily, it can contribute to it, but it's very complex, blah, blah, blah. But it's not that complex, really. Come on. Like, you print money, put it into the system, money will go somewhere. It's got to go somewhere, okay? You're not going to just buy, if you're a family, if you're eating one Big Mac, you're not going to eat 2 Big Macs tomorrow just because you got more money in the system. That's not how it works. You can spend so much, but eventually rich people are going to just buy houses. That's what they're going to do, or invest in shares. That's where the money is going to go. So then I asked the top 10 reasons again and a percentage contribution to Perplexity. And then it gave me this list. Low interest rates, 25%. Population growth, you can read it yourself. So 15%, blah, 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 blah. And then, again, it didn't come up with monetary expansion as one of the points. So I said, why didn't you talk about monetary expansion in the original answer? Why didn't you mention monetary expansion as a potential cause of the house prices going up? Oh, it said, I'm sorry, but, because the discussion is most of the time. Actually, I asked ChatGPT this question. It actually said, it's because it's too hard for people to understand, so we didn't talk about it. And also said that people don't talk about it because it's kind of in the background. So it said it was an error on my part. Indeed, it is a significant factor. The omission likely occurred due to focusing on more commonly discussed factors without fully considering the broader monetary policy implications. It's like, so if you're a high schooler and you're trying to understand why house prices are going up and you ask ChatGPT, it won't even mention this as a potential cause, even though when I asked it, give 5 reasons, okay, for why the prices are going up, and give a percentage for what the contribution you think AI in the last 20 years. And this is what it said. And I can tell you that when you can try it yourself. Ask the question, give 5 reasons why house prices in Australia are going up, include monetary expansion, and give a percentage. And it gives you this rough calculation. It says low interest rates, 30%, monetary expansion, 25%, okay? Population growth, 20%, limited housing supply, 15%, and government policies and incentives, 10%. So we're spending all this time talking about the government policies and incentives, and these numbers are very rough. But look, let's just say it's roughly 10%. Let's say it's 15%. Let's say it's 20%. Doesn't matter. But the point is, it's not the major thing. The government policies are not the main thing that are causing the house prices to be so high. Monetary expansion and low interest rates are linked together, because if you expand the money base, interest rates are going to drop. So the two are actually intertwined. But even if you took the monetary expansion just by itself, artificial intelligence estimates it to be 25%. You could ask ChatGPT in the last 10 years, and I think it gives a figure like 30%. In other words, it's a massive reason why the prices have gone up. It's because the government has printed money. The government has printed money. And the thing is, the government is going to continue to print money in times of crisis, because that's how it helps the economy become more liquid, because we're in this debt-fueled economy. Now, in 2013, there was this, I tried to look up this topic actually on the internet, and you can try it yourself. It's actually not that easy to find good quality information about this particular topic, how money supply affects house prices. And I don't know why, because even according to artificial intelligence, it's actually one of the main reasons why the house prices have gone up. And literally almost nobody talks about it. In 2013, there was this actuarial presentation. Now, if you don't know what an actuary is, these are like super smart people that calculate, that basically are mathematicians, and they sort of predict things and they take factors into account. If you're an actuary out there, you can explain your job better than I can. All I know is that they look at numbers, and then they try to make sense of like complex patterns with numbers. And so they're the guys that will calculate how much your insurance should be for your house and for your car, etc. And in this article here, and you can look at the source here, they said that the money supply is rapidly expanding. And this was back in 2013, before COVID. So this is crazy because, yeah, anyway, we've already talked about this. 1971, we had a base of 1.48 billion. In December 2012, it had gone up to $53.8 billion, an increase of 36.4 times. M3, which includes term and other deposits with banks, rose from 17.1 billion to 1,517 billion, an increase of 88.9 times. That is insane. And in the 5 years, it rose, M3, 5 years of December 12, it rose by 532 billion. Anyway, these numbers make no sense to me because they're just so big. I think the point is, over the past 20 years, money supply has increased by 9.6% per annum. This is what I was saying before. So the money supply has been increasing. I think somewhere else we said 7%. But anyway, it's more than the 2.7% CPI. CPI understates the overall increase in goods and it says may understand the overall increase in goods. It definitely understates it. But it does seem that a significant portion of the increase in the money supply has found its way into asset prices. Okay, this is not me saying it. This is the actuary saying it in this article. Now, it said that there are currency debasement risks. So this person by the name of, I don't know how to pronounce, Mises argues the recurrence of periods of boom, which are followed by periods of depression, is the unavoidable outcomes of the attempts repeated again and again to lower the gross market of interest by means of credit expansion. He adds, there is no means of avoiding the final collapse of boom brought by credit expansion. The alternative is only whether the crisis should come sooner as a result of voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. What they're saying here is essentially, if I can read this correctly, is that if you keep printing money, eventually your financial system doesn't work, because you can't just keep printing money, because money becomes worthless. The final collapse of the paper money system involves the public losing faith in the value of money. The demand for money collapses. Those holding nominal assets such as government bonds suffer large losses in real terms. So this explains that money is essentially becoming worth less. And so, quote unquote, real assets like gold, which are limited, and houses, which are limited because they're on pieces of land, which are also limited, like real actual things that you can hold that are not money, these actual things, they will increase in value relative to the value of money because you're counting it in terms of money, but they're not actually increasing in value. It's just that there's just more money in the system, so it becomes worth less. So one way to understand it is like if in my house we have 4 people and we all have this money, currency that we just made out of thin air. Everybody gets, monopoly money. Everybody gets like $10 each, so there's $40 in the system. We can use that $40, for example, to buy goods and services from each other. That's fine. So if I say pay my son to clean the car and I use 10 of those dollars, then it's worth $10 in the monopoly money. But then if somebody randomly goes, okay, from now on everybody just gets $20, so now we've got $80 in the house, I can get him to clean the car, but I'm not going to charge him, I'm not going to pay him $5 because now the $5 is not worth $5 anymore because it's now worth, now you got to use $10 because proportionately, the money is just worth less. So as you keep putting money into the system, the value of the money gets less, which then makes it look like the asset prices go up, just like the car cleaning service suddenly looks like it's gone more expensive, but it didn't really because everybody's just got more money, okay? So get ready for the currency crash. So essentially the actuaries were saying that CPI is only a measure of inflation. You shouldn't just take that into account. You've got to, as an actuary, as you smart people that do maths and all that, should focus on how changes in the money supply affect the key assumptions, including the asset market's returns and wage rate forecasts. You notice that the wages don't go up? When the assets, when you keep printing money, you're not getting paid more. The money is going into the houses, into the stock market. Actuaries should be aware the current government fiat money system is unsound and that Australian economic theory shows that the unsound money system is facing a final and total catastrophe. Wow, this is strong language. In particular, this has significant implications for those individuals and organisations that have nominal assets and real liabilities. There you go. That was pretty heavy. In summary, the house prices are going up for multiple reasons. All the reasons that the news talk about, I'm not going to reiterate them because everybody's talking about those talking points: immigration, not enough people to build the houses, etc., blah, blah, blah. But despite the headlines, one of the main drivers is monetary policy, which is the increase in money supply, which is called monetary expansion, which has been happening underneath our noses without anybody talking about it. Nobody's voting for the government and saying, please stop printing money, or please don't stop printing money. Nobody seems, because they're not necessarily the ones that do it. It's the RBA that does it, so it's not really the politicians that do it, so they get to get away with it. But it's happening. It's happening. It's going to keep happening because we live in this debt-fueled society. I mean, in the international world, it's all debt-fueled. House prices are not necessarily increasing in real terms. In others, money is losing value, so it looks like house prices are going up. And look, we can all talk about this and philosophize and blah, blah, blah. But from my point of view, one of the main issues here is the middle class, okay? That's normal people, like non-millionaires. The middle class. Look, there's going to be a lot of millionaires just because they seem to own. The thing about the house prices going up is that you're not actually getting necessarily richer unless you have multiple houses or you can downsize. Because if you think about it, if you're a family and you own one house and your house price goes up and you never sell that house, you're not any richer, okay? Because if you needed to sell that house, or if you wanted to buy a house for your kids, the houses are so expensive you can't afford to buy the house for the kids, so they've got nowhere to live. So I don't think many people win, okay? I think rich people win from this system, but not many people will win. So the middle class, as in like non-multimillionaires, need to have a property to prevent ongoing deterioration of their living standards, including the income, because essentially the average house is earning more than you are, okay? So the median house price in Sydney is 1.4 million or whatever it is, and that house price goes up by 10%. It just went up $140,000, okay? And you, if you're a median wage earner, even if you're earning like, I don't know, whatever it is now, 90,000, 100,000, you're earning less than that asset price going up. So essentially your house is earning more than you are. As long as the financial system as it stands continues, asset prices, including real estate, will continue to inflate. That's just a reality. So all this talk about the crash, the problem is very few, there's less people in Australia that actually want the house prices to crash, okay? Young people probably want the house prices to crash. But even if they do crash, guess what? That's not necessarily good for the economy either, okay? You probably won't have a job if that happens, but I don't know. It could be it's probably a good thing. It has to be a slow reduction, okay? So I'm all for the house prices going down. At some point, theoretically, the financial system, which some people would call a house of cards, may collapse and money could one day become almost worthless in theory. But that means that it's actually good to have real assets. And the funny thing is, using debt to buy a house is actually not a bad idea, because that debt is essentially losing its value over time. This is something that there's a great YouTuber that talked about this. And essentially he said that, I think his name is Ravi Sharma, and he's an Australian real estate guy, and he's got some really good points about this. And he says that essentially your debt is actually just losing value, which is great. So if you borrow 100,000 today, that 100,000 in 10 years time might be worth like 40,000 or 50,000. So essentially your debt is losing value. That's a crazy cool way of thinking about it. I'm not saying that everybody needs to get into ridiculous amounts of debt. So you got to do due diligence, make sure you've got an ability to, to service that debt. I'm just going to make sure that I said his name right, because, his name is, pretty sure his name is Ravi Sharma. Yeah, Ravi Sharma. The other really cool YouTuber that I learned a lot from was PK Gupta. So shout out to those guys. And there's a UK economist by the name of Gary Stevenson, who talks a lot about this sort of money supply issue as well. Not that I agree with everything that everyone says, but I learned a lot from these guys. So essentially, buying a house, using debt to buy a house is not a bad idea, because your house prices are almost definitely going to keep going up. It's not a guarantee, but over time, it's almost guaranteed, because like we've talked about, there's so many factors working against house prices going backwards. And so I think the takeaway point here is that we should help the next generation really get into the property market, and really encourage there to be more homeowners, because we don't really want more investors in the system. We need to have more homeowners, and I do strongly believe that this goes without saying, everyone should be able to buy a house. If you work a normal job, I think it's fair to say that most of us want people to be able to afford a house. I mean, come on. When I was growing up, after uni, I'm pretty sure all of my friends could afford a house after uni. And it's just not the case now. And I feel sad. And I think that the system is rigged against younger people, against the quote unquote working class, which is like most of us. And this money printing is part of it. So I think it's worthwhile for you guys to get the message out, to understand what's really happening, and then to do something about it. And I think also the discussion needs to be had at the political level, to not just talk about these other factors like immigration and supply and demand factors, but also what on earth we're doing with monetary policy, particularly in times of crisis, like when there was COVID and they're just handing out large amounts of cash, and then quantitative easing and all that. So in the short term, it's a sugar fix, but in the long term, we keep increasing the money supply, and things are looking worse and worse for the average person in Australia and around the world as well. So I hope that helps somebody. I hope it doesn't make you feel really jaded and cynical about the world. It certainly was an eye-opener to me. I'm going to try to do this video again down the track in a more succinct form. Maybe do a YouTube short or something for people with shorter attention spans. And yeah, just keep educating yourself, and I hope that's been helpful. So all the best to you guys, and I'll see you next time.